The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled Merger Policies of the Federal Banking Agencies. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Mergers of financial institutions can promote competition and generate cost savings that can then be passed on to consumers in the form of lower interest rates on loans, reduced fees, and higher interest paid on deposits. Clear expectations and timeliness surrounding merger reviews are critical so banks can make informed decisions about whether to pursue a merger when approval is likely or withdraw an application when it is not. Bank mergers, especially those involving mid-sized regional banks, help preserve a robust banking system and promote competition. They also allow community banks to overcome onerous regulations and meet technology needs. It is far better for distressed banks to sell themselves than to fail and rely on FDIC receivership, which would result in significant costs to the Deposit Insurance Fund. Those claiming that regulators, quote, rubber stamp merger applications either lack understanding of the merger processes and economics or purposefully misguide the public about the facts. We have heard from federal banking regulatory officials that they value breadth in our banking system, which is the envy of the world and includes small community banks, regionals who serve consumers and businesses in our communities, and large banks that compete in the global arena. Recent actions by the FDIC and OCC to update their merger review processes, however, do not conform with regulators' claims that they value our broad and diverse system. As numerous prominent witnesses in the subcommittee have noted, the recent fatally flawed Basel III endgame proposal sets up economics that drive banks toward merger and acquisition activity. The Basel proposal, the Dodd-Frank Act, and an onslaught of other recent flawed proposals impose unnecessary and unjustified costs onto regional and small banks. Banks are forced to try to better spread those costs over added business lines and activities. And so, the regulatory onslaught sets clear incentives and the necessity for mergers and acquisitions. At the same time, the FDIC and OCC want to make mergers all the more difficult, injecting sluggishness into their processes, even for mergers that clearly meet the approval criteria under the Bank Merger Act. With varying proposed conditions for merger approval, the FDIC, OCC, and the Fed would be operating with different approval processes and standards, injecting additional uncertainty, incentives for regulator shopping, and negative consequences for the dynamism of our banking system. At a time when there are already many questions about sequencing with the DOJ, the differing approaches to antitrust screenings put forward recently by the FDIC and OCC creates more divergence and increases the likelihood of confusion for institutions. Today, we will try to get insights into why the opaque and too often partisan policy positions of the FDIC and OCC have driven them to put forward their suggested new merger guidelines. It should be noted that the FDIC proposal came in March of this year, which is odd given that Chairman Gruenberg and Director Chopra in December of 2021 seemed to have felt that working on mergers was so important and urgent that they had to violate long-standing FDIC procedures and engineer a thinly veiled coup against then the chairman of the FDIC. Chairman Gruenberg and Director Chopra hit pause on their urgency for more than 2 years before working to produce a partisan FDIC merger proposal, reinforcing that they acted in 2021 to usurp the powers of Chairman Gruenberg's predecessor. The recent FDIC and OCC proposals are clear steps in the wrong direction. With that, I will note that there are 3 bills attached to this hearing related to the merger processes. The first is my bill, the Bank Failure Prevention Act, to improve the timeliness and clarity of the merger application process. The other 2, the Business Loan Privacy Act and the Lender Act, work to provide clarity over CFPB rules, which are part of the onslaught of confusing and misguided regulatory efforts that force mergers as banks need to spread their ever-growing regulatory burden over additional business activities. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chairman Barr, and thank you to our witnesses for joining us today. Since the 1980s, there's been a steady consolidation within the U.S. banking system. In 1984, there were more than 14,000 commercial banks operated within the United States, and today that number is down to around 4,000. Some of this concentration may be attributed to changes in the regulatory and legal landscape. Some of it's due to the natural economies of scale as banking becomes more and more digitalized. Some is due to the simple fact that young people continue to move out of rural areas and into the larger cities that are the natural habitats of the larger banks. But beyond structural changes, mergers and acquisitions have been pursued by financial institutions seeking access to new markets, economies of scale, and technologies that often benefit the institution and its customers. In Congress, through the Bank Merger Act and related legislation, we've rightly recognized that not all mergers are created equal, and that some acquisitions can pose either threats or benefits to competition, to financial stability, and Americans' access to financial services, particularly in historically underserved communities. And for that reason, federal banking regulators are tasked with the responsibility of reviewing bank mergers to prevent the resulting institutions from undermining financial stability and the financial needs of Americans. Maintaining a healthy size distribution in the banking industry is a bipartisan concern. When I was a business owner, I saw firsthand the value of having a diverse banking system with a wide distribution of bank sizes. Having multiple banks in a community competing for your business strengthens the negotiating power of small businesses and households and forces banks to compete for their business, and often leading to better terms, interest rates, or service. Americans are better off when we have options, and we should strive for a competitive marketplace for banks of all sizes, from community banks to GSIBs. In 2021, President Biden issued an executive order encouraging regulators to take steps to promote market competition across our economy, directing specifically to the Department of Justice and federal banking regulators to review and strengthen their banking merger review policies. And today we will discuss the state of American banking industry and proposed updates to the merger review policies of the OCC and FDIC. The proposals naturally and rightly increase scrutiny of complex mergers among the largest banks, focusing on key risk indicators like rapid growth, which partly contributed to the failure of Silicon Valley Bank last year. The proposals face an emphasis on integration planning to ensure that the resulting institutions and their management will operate in a safe and sound manner. The proposal will also ensure that the affected communities have an opportunity for their voices to be heard. Both the FDIC and OCC are currently accepting comments on these proposals, and I encourage the regulators to actively engage with the comments they receive, at least those that are not AI-generated bot nonsense. Americans benefit from strong and diverse banking system with competition at all levels. So I would look forward to hearing the perspectives of our witnesses who played a key role in developing these proposals. Thank you, and yield back.
Today we welcome the testimony of James L. Anderson. Mr. Anderson is Deputy General Counsel at the Federal Deposit Insurance Corporation, and Mr. Ted Dowd. Mr. Dowd is Acting Senior Deputy Comptroller and Chief Counsel of the Office of the Comptroller of the Currency. We thank each of you for taking time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Anderson, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Barr. Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to appear today to discuss the FDIC's role in bank merger transactions. My written statement today will summarize the statutory framework under which the FDIC evaluates bank merger transactions, the current merger application submission and review process, and finally, recently proposed updates to the FDIC's Statement of Policy or proposed SOP on bank merger transactions. The FDIC is one of 3 federal banking regulators with responsibility for evaluating transactions subject to the Bank Merger Act. Section 18C of the FDI Act, which codifies the Bank Merger Act, prohibits an insured depository institution from engaging in a merger transaction without regulatory approval. The FDIC has jurisdiction to act on transactions that involve IDIs in which the acquiring, assuming, or resulting institution is an FDIC-supervised institution. The FDIC also has jurisdiction to act on any merger application that involves an IDI and any non-insured entity, notwithstanding the IDI's charter. In assessing merger applications, the FDIC evaluates each application against the same statutory factors under the Bank Merger Act, regardless of the size of the parties to that transaction. Those factors include monopolistic and anti-competitive effects, the financial and managerial resources and future prospects of the existing and proposed institutions, the convenience and needs of the community to be served, the effectiveness of any IDI involved in that proposed merger transaction in combating money laundering activities, and the risk to the stability of the U.S. banking and financial system. The FDIC implemented its responsibilities under the Bank Merger Act by codifying regulations, issuing a statement of policy on bank mergers, and publishing an applications procedures manual. Although there has been significant amount of consolidation in the banking sector over the last 30 years, due in part to mergers and acquisitions, there has not been a significant review of the implementation of the Bank Merger Act by the banking agencies in that time. Accordingly, the FDIC Board of Directors approved a Federal Register notice on March 21st of this year, seeking public comment on proposed revisions to the agency's statement of policy, which is our proposed SOP, on bank merger transactions. The proposed SOP reflects significant regulatory, legislative, and industry changes including the Dodd-Frank adoption of the financial stability test. The proposed SOP would update, strengthen, and clarify the FDIC's approach to evaluating transactions that are subject to the Bank Merger Act. Additionally, concurrent with the proposed SOP, the FDIC is seeking comment on proposed revisions to its supplemental section of the Interagency Bank Merger Act application. In conclusion, extensive consolidation has occurred in the banking industry over the last 30 years, some of which is certainly due to bank mergers. In that light, the effectiveness of the regulatory framework in meeting the requirements of the Bank Merger Act is critical to the future safety and soundness, financial stability, community accountability, and competitiveness of the banking system. As such, conducting a review of that framework and seeking public comment on the review process is certainly warranted. The FDIC will continue to collaborate with other federal banking regulatory agencies as it considers the appropriate framework for reviewing bank merger transactions. The FDIC remains committed to engaging with the public, industry stakeholders, and indeed members of Congress in support of this mission. Thank you, and I look forward to your questions.
Thank you. Mr. Dowd, you're now recognized for 5 minutes.
Thank you. Chairman Barr, Ranking Member Foster, and members of the subcommittee, I am pleased to testify today to discuss the Office of the Comptroller of the Currency's review and consideration of bank merger applications. I currently serve as the OCC's Acting Senior Deputy Comptroller and Chief Counsel and oversee the agency's legal and licensing activities, including applications for bank mergers and other business combinations. The process by which the OCC considers bank mergers involving national banks and federal savings associations is governed by federal law and regulation and the OCC's licensing manual on business combinations. The OCC carefully reviews each bank merger application received and must provide approval before a bank may consummate a merger. The OCC supports a diverse and competitive banking system and appreciates the value that community, midsize, and large banks provide to the communities and businesses they serve. Our bank merger application review process allows for robust and thorough consideration of statutory and regulatory factors, as well as public input into the process. Under the Bank Merger Act, the OCC is required to consider 5 factors when conducting reviews of bank mergers. These include 1, the effect on competition, 2, financial and managerial resources and future prospects of the banks involved, 3, probable effects on the convenience and needs of the community served, 4, banks' effectiveness in combating money laundering activities, and 5, the risk to the stability of the U.S. banking and financial system. Separately, under the Community Reinvestment Act, the OCC is required to assess an applicant's record of meeting the credit needs of its entire community, including low and moderate income neighborhoods, consistent with safe and sound operations. The OCC also considers several regulatory factors, including the capital level of the resulting bank, conformity of the transaction to applicable law, regulation, and supervisory policies, purpose of the transaction, impact on the safety and soundness of the applicant bank, and the effect on the applicant bank's shareholders, depositors, creditors, and customers. Public input is important to the OCC's review of bank merger applications. To facilitate transparency, the OCC posts the public portion of applications on its website and initiates a formal comment period for at least 30 days. The OCC carefully considers all comments received from the public, including comments from public meetings or hearings. The OCC recognizes the importance of ensuring that the bank merger process reflects the economic realities of today and results in healthy and sound mergers. In February of 2023, the OCC hosted a public all-day symposium on the bank merger process to explore the effects of mergers on competition, financial stability, and community convenience and needs. Information from the symposium informed the OCC's more recent efforts to update its analytical framework for bank mergers. Toward this end, the OCC is committed to working with the Federal Reserve, the FDIC, the Department of Justice, and the Department of Justice to ensure appropriate coordination and collaboration in each agency's consideration of bank merger applications. In addition, earlier this year, the OCC issued a proposal to update its rules and policies for bank mergers to enhance transparency around the decision-making process under the Bank Merger Act. It includes a policy statement that describes features of applications that are generally consistent with OCC approval and those that raise supervisory or regulatory concerns. The proposed policy statement seeks to provide more information and clarity around our decision-making. For example, it notes that applications where the acquiring bank has satisfactory supervisory ratings, no open enforcement actions, and no fair lending, CRA, Bank Secrecy Act, or consumer compliance concerns, along with other features, are consistent with timely approval. We recently extended the comment period on the proposal until June 15th and encourage all stakeholders to provide comments. In conclusion, ensuring continued diversity and competition in the federal banking system is of critical importance to the OCC. As the OCC continues to work with other regulators and the DOJ on updating its analytical framework related to bank mergers, we are also taking steps to improve the processes by which we consider bank merger applications and the transparency around our decision-making. We welcome further engagement on these matters. Thank you, and I look forward to answering your questions.
Thank you to our witnesses for their testimony, and the ranking member has arrived. And would the ranking member like a minute for an opening statement?
Very much. I appreciate that, Mr. Chief. Thank you. As bank mergers continue to be rubber-stamped by regulators, people across America pay the price through higher junk fees and predatory actions. For example, after Wells Fargo's mergers, it became too big to manage and repeatedly broke the law, harming millions of consumers. If mergers like these continue, we will be left with only a handful of mega banks that will be empowered to fleece everyone. Following the news of Capital One's proposed merger with Discover, I urged the government to block it and led a letter with 15 committee Democrats to the bank regulators to immediately strengthen their merger reviews. I'm pleased that the OCC and FDIC issued proposals to do that, although the Fed has not. And so I just have to mention two things quickly. One is that there is a lawsuit against Wells Fargo because African Americans were denied refis, 50% of what they tried to get. And then there's another one where Wells Fargo used Latino employees to literally fleece Latinos in the way that a product was being produced.
The gentlelady's time
we just
has
have to
expired.
know these. Thank you very much. And
Thank
I
you.
yield back.
Gentlelady's time has expired. We'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. Mr. Dowd, I really enjoyed a recent conversation I had with Acting Comptroller Sue, and I appreciate his thoughtfulness on this topic. As I communicated to him, my view is that it far too often takes 12 months or more to approve a merger transaction, and in some instances even longer than 12 months. Ironically, my Democrat colleagues contend that this long, drawn-out process is a mere rubber stamp. But isn't that just too long, Mr. Dowd? Can you describe some of the negative consequences for shareholders and employees when applications are pending for a long length of time?
Thank you, Mr. Barr. I appreciate the question, and it is a very important question in terms of how the federal banking agencies consider bank merger applications that are in front of the agency, and our coordination with our peer regulators at the Federal Reserve, the FDIC, and the Department of Justice. I will say that, in general, the complexity of the application is highly correlated to the timing of a decision on the application. So when you think about the bank merger applications and business combination applications that come before the OCC, the vast majority of those are processed in what I would characterize as a very timely and quick fashion.
Well, just reclaiming my time, Mr. Dowd, for those that are not processed in a timely manner, the concern is that customers, shareholders, and employees of the target bank are left on the hook indefinitely to see share prices drop and employees depart. We've seen this recently with target banks. To avoid this, can you or the OCC support legislation that ensures applications are processed in a timely manner and deemed complete in a set time frame? I'm from Kentucky, and we like basketball. It's kind of like a shot clock. We'd like to see a shot clock. It can be a no. The answer can be a no. But the regulatory purgatory, the indecision, is what we're concerned about here.
Understood, and I think the analogy is one that I relate to, and I would think many at the OCC relate to. I do have a Knicks fan behind me, so we'll dispense with that for the moment. But I was born in Springfield, Massachusetts, the home of the Basketball Hall of Fame.
Very good.
I am very familiar with the concept of a shot clock. More importantly, I am familiar with the legislation that you and your staff have been working with the OCC and our staff on. I believe that we have had some very productive discussions on that front, and I think we look forward to continuing those discussions with your staff. And I think there are many important and valid ideas for consideration in that proposal.
Thank you. I look forward to continuing to work with the OCC on that, and I value that collaboration. Mr. Dowd, let me talk about these community benefits agreements. In current law or under the OCC's proposed rulemaking, does a bank need to have entered a community benefits agreement in order for you to conclude that the merger application would meet the convenience and needs of the community?
The short answer is no. I will say that the engagement between banks involved in a merger application and community benefit groups can be very helpful in terms of thinking forward on the convenience and needs factor, which is obviously one of the 5 statutory factors that has to be considered and has to be reconciled before there is a decision with respect to approval on a bank merger act. So in general, they can be helpful.
Yeah.
They are not necessary.
And this is actually where the rubber meets the road. I mean, even if it's not required as a matter of law or policy, it's still required as a practical matter in cases where a community group has filed an adverse comment on a merger application. And my concern here is that the agencies are outsourcing the convenience and needs prong of the statutory review factors by requiring a community benefits plan to get merger approval, even if it's just de facto, and that effectively confers upon the community groups a great degree of leverage to extract favorable deals, sort of a blackmail or extortion situation, if I may state it frankly. Maybe the OCC doesn't see it that way. Certainly community groups don't see it that way, but I can tell you that banks that face thwarted deals see it that way. Are you all sensitive to that?
We are sensitive to it. We consider it one part of the process, and I will conclude by saying we do have an NPR, and we welcome comments on that issue and all other related issues.
My time has expired. I've got more questions, but we'll need to move on, and I appreciate the gentleman's feedback. The gentleman from Illinois, Dr. Foster, is now recognized for 5 minutes.
Thank you, Chairman Barr, and again to our witnesses. First, a quick question on sort of the process of how this works. As you are reconciling the various and sometimes competing factors involved in a merger decision or regulatory approval for a merger, how is it done? Is there some sort of point system where if you get enough points, it'll get approved? Is there a committee vote? How formal is this?
Thank you for the question. It's a very good question. It is a comprehensive and holistic process. So we start with the 5 factors that are articulated in the Bank Merger Act that are required considerations for the OCC and the other federal banking agencies. So effect on competition, financial and managerial resources and future prospects, convenience and needs, BSA, AML compliance, risk to the financial system and financial stability. And then beyond that, we have regulatory factors in Part 5 of the OCC's regulations that is a regulation implemented consistent with the Bank Merger Act. And so on that front, we consider the capital level of the resulting bank, conformity of the transaction or the ability to conform with applicable law, regulations, supervisory policies, the purpose of the transaction.
So my question was, okay, you got all these factors, some may be positive, some may be negative. How do you add them all up to a decision? Is it done, with any kind of formalized, what's the logic of the final decision given all of these factors, some of which may be positive or negative?
It's facts and circumstances. So of the factors that I mentioned, there are some applications that come in the door and they are very clean on many of those factors. There are some factors where we will have additional questions and we will focus effort on those additional factors. But in general, it is facts and circumstances.
Okay, no, I understand the inputs. What is the mechanism for the final decision? Is there one person who just decides? Is there a committee and everyone leans back in their chairs and votes? How does this actually... What is the mechanism for, once you've evaluated all these competing, potentially conflicting requirements? Mr. Anderson, can you help me out here?
I can try. At the FDIC, there is not a mathematical formula, as part of what the question you were asking. And it is a very iterative process. We do take the very same statutory factors that the OCC looks at, and frankly, we go through and try to match up the information that's provided to see if ultimately those factors can be resolved. And to the extent that each factor is resolved positively, if you will, then the FDIC will approve the application. If we're not able to resolve each of those factors positively, then we will make a recommendation either to deny the application or to allow it to go to the board, because at the FDIC to the extent...
Okay, I think I understand. It's essentially subjective, which may be the right answer here. Now, yesterday I discovered the topic of mergers and acquisitions with a group of Illinois community bankers, and some from my district, and specifically in anticipation of this hearing, I asked them about the amount of time that it has taken them to get an answer regarding the outcome of merger applications at their smaller banks as they have filed with your agencies. The group had no complaints about the timeline, and they said that they would typically receive a response well within 90 or perhaps 120 days. I recognize that there's concern from members of this committee that it takes too long to resolve a merger application, and at least for the community bankers that I spoke with from Illinois, this doesn't seem to be a concern. However, I would expect that the review process would naturally take longer as the size and complexity of the merging institutions increases. So to the extent that we might consider a shot clock, a legislative time limit on regulatory approvals, it seems like the time should be appropriately scaled to the size and complexity of the contemplated merger. So, Mr. Dowd, in your experience, does it take longer for the OCC to confidently review a merger between banks with hundreds of billions of dollars in assets than a merger of smaller banks?
So I would say just a natural function of a potential merger between two large institutions adds complexity to the transaction and the review that needs to be conducted by the regulators to ensure that the resulting bank at the end of the process is a bank that can operate in a safe and sound manner and has the appropriate systems and controls in place to comply with the applicable law and operate in a safe and sound manner. Again, I will note that the NPR that the OCC recently issued does list a number of features that would be consistent with timely approval. So That would be satisfactory supervisory ratings, no open enforcement actions, no fair
Okay, I
lending
guess
concerns.
I'm afraid I'm running out of time here, but thank you for your response.
Gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized.
Thank you very much, Chairman Barr. The both of you, have either one of you ever worked in a bank?
I have not.
When I was in college, I was a bank teller. Beyond that, I've never worked in a bank.
How would you know, each of you, what kind of impact local banks have on their communities? I think that's something you consider when you make your decisions. How do you have that insight? How do you gain that insight?
Well, sir, to your point, I have not worked at a bank. We certainly have people at the FDIC who have. We do have people at the FDIC with that type of expertise. And so I would say that staff that reviews an application reviews those statutory factors and weighs the application, if you will, against those statutory factors to take a look at those concerns.
I would agree and endorse everything that Mr. Anderson said. I would also elaborate on that a little bit to say that at the OCC, our core mission is bank examination, which means that we have examiners on the ground at banks, at the largest institutions.
Okay. Next question. Do your rules say anything about putting loans on non-accrual basis if the loan is greater than the appraisal of this collateral?
The current OCC notice of proposed rulemaking that is out for comment to.
No, I'm not talking about the proposed rule. I want to know if your rules prohibit putting a loan on non-accrual simply because the collateral is lower than the loan.
I would have to look at the rule. Off the top of my head, I do not know the answer to that question.
Unfortunately, no do I. I would have to look at the rule as well.
Okay. So you wouldn't know if the regulators have ever violated that rule?
Again, I would have to look at the rules.
Sitting here and now, I don't have the information I would need to answer that question, but I would be happy to have our staff engage with you and your staff, and I think that is a question that we could answer very quickly following this hearing. We just need to look at the rules.
Some OCC regulators in here sometime to find out how it really works, since the guys at the head of the agency don't know. Mr. Dowd, how does OCC account for increased competition from non-bank financial institutions like fintechs in assessing the competitiveness in bank mergers?
Thank you. It's a very good question. So going back to the statutory factors in the Bank Merger Act, so we have to consider the effect on competition. We have to consider the convenience of needs of the community served. So in that process, I think it's natural to look at not just what the landscape of the banking community is in a particular community, but also how financial services are delivered in general, both within that community and on a basis of scale throughout the United States. One of the things that our NPR addresses is the idea that we have these principles from 1985 with the Department of Justice about how bank mergers can be considered, and I think there is at least a recognition within the OCC that the landscape and the manner in which financial services in general and banking services in particular have been delivered since 1995 has evolved considerably, and we need to think about that, and that is part of what we're doing with our notice of proposed rulemaking.
Mr. Anderson, does your research suggest that larger banks have a greater or lesser capacity than smaller banks to diversify holdings to help reduce risk? And how's that addressed in your analysis?
I'm sorry, can you repeat the question?
Yeah. Does your research suggest that larger banks have a greater or lesser capacity than smaller banks to diversify holdings to help reduce risk, obviously. And how is that discussed in your merger analysis?
I'm not certain that that's discussed in our merger analysis. I would say that's something that we would have to look into.
Thank you, Chairman. My time has expired.
The gentleman's time has expired. The gentlewoman from California, Ms. Waters, is recognized.
Thank you very much. Mr. Dowd, I appreciate that the OCC recently extended its public comment period for the proposed merger of Capital One and Discover. I and many others are strongly opposed to that merger, and it is important that the OCC, along with the Fed, conduct robust due diligence and give affected workers, consumers, small business owners, and communities the opportunity to share their views on the merger. I also appreciate that in the OCC's proposal to improve its merger reviews, you're considering ways to convene more public hearings on large consequential bank mergers. The proposed merger of Capital One and Discover would seem to meet this test if it were approved. It will form the 6th largest commercial bank that would also be the largest credit card lender in the United States. Accordingly, will the OCC commit to holding multiple public hearings on this proposed merger so that members of the community can have their voices heard? Some may be wondering why I put so much time and attention on examining these mergers and thinking, oh my goodness, mergers are good for the economy. You should be doing everything that you can to make sure that it occurs in a timely manner, as you're being told by some on the opposite side of the aisle. Wells Fargo has taught us a lesson. Wells Fargo is the 4th largest bank, and we know that they're too big to fail. And they became big because of these mergers that they have been involved in. And now they're being sued for race discrimination in mortgage lending practices, and Wells Fargo workers have alleged that anti-Latino bias in predatory mortgage schemes is what is going on at Wells Fargo. So you can thank Wells Fargo and all of its mergers for the size that it is and the way that it has conducted itself. That's why we've got to know more about these mergers. OCC, are you thinking about more public hearings?
Thank you, Representative Waters. That is an excellent and a timely question. I'm not in a position to talk about any particular merger that is pending before the OCC, but I will say that the policy statement that is attached to the OCC's NPR on bank mergers is helpful and instructive on this point. And paraphrasing, there is a presumption in that policy statement that there is a lien for public hearings for institutions or applications that involve the merger of institutions that exceed over $50 billion in total consolidated assets. So with that as background in terms of what the OCC has most recently said with respect to the value of public meetings on these large merger transactions, I will also add that it is the belief at the OCC that the public comment process, both written and in public meetings, is critical and vital to understanding all of the multiple facets to these transactions.
Thank you so very much. I just want to remind everybody, this merger will create the 6th largest commercial bank, and Capital One will be the largest credit card lender in the country. This is not small stuff. This is big stuff, and we must pay attention, and we must understand what we're doing to either support mergers without knowing exactly where they're going and what they're going to do and how the public would, be harmed in some ways. So I thank you very much for, your attention to public hearings. Years ago, the communities would absolutely be contacted, and we would form, partnerships with all of the locals that were interested, all of the stakeholders. We would go to these public hearings and we would have a say. And that was even before I was an elected official. And so I'm looking for more of this, and I yield back the balance of my time.
Gentlelady yields. The gentleman from Missouri, Mr. Lukemeyer, is recognized.
Thank you, Mr. Chairman. I don't really know where to start on all this because it's very frustrating to me to see the regulators in front of us this morning who handle the ability of banks to be able to merge, to be able to protect themselves, to be able to do business in the communities they do business in. And we've seen the last 2 years, the lack of regulatory oversight, inability to do your jobs, your ability to close a merger on these banks, Silicon Valley, Signature, and those other banks, in a very, very, very short time, weeks, days. And here we're talking about mergers that take sometimes years. What's the difference? Mr. Anderson, what's the difference?
Not certain I'm understanding your question, sir.
Well, you could, in an emergency situation, you can figure out how to streamline, cut red tape, make things work. But in a situation where you're sitting there strangling these other banks to keep them from merging, which they, on their own, have decided to do, and we'll get into the reasons in here in a minute, but you're strangling them from being able to do that. It takes weeks and weeks, sometimes years, to get that done. Why?
Well, certainly, Congressman, that is not our goal. I mean, our goal is to process.
I didn't say it's your goal. I'm saying why it's happening.
Well, I would say that certainly each application we have to look at based upon the facts and circumstances of those applications. I would certainly say the vast majority of merger applications that we get do not take years and years to resolve. There are some.
No, Mr. Anderson, it takes months. It takes months to do that. I've been in the middle of mergers, 2 or 3 of them myself. It takes months to get this done. There's no reason for that. I think our chairman has got it right. We need a shot clock on you guys to make sure that you do this job and do it correctly and keep the uncertainty from happening to the 2 banks involved. This is nonsense.
Congressman, I understand your question, and as I indicated earlier, our proposed SOP is out for comment. Those are the exact type of comments that we would appreciate receiving, and we'll take them under consideration.
You know, one of the problems that we have is that the amount of regulations flowing is just inordinate. It's unbelievable. I saw an article this morning. I had to read it 3 times to make sure I read it correctly. But the article said that since January 1, this administration, Biden administration, has promulgated now and codified $1 trillion worth of new rules and regulations. That's right, with a T, $1 trillion worth of regulations. We've had testimony in some of the committees I've been on that over the last 3 years, it's $150 billion per year. This first 4 months of this year just blows that all out of the water. And a lot of this, not a lot in this $1 trillion stuff, but a lot of the other rules and regulations involve banks and the cost of doing business for them. Yesterday, I had a bunch of independent community bankers in my office. And we're talking about the rules and regulations, and I said, well, do you realize that there's thresholds on some of these rules that you don't have to abide by? You know what their comment back was to me? They said, you know what? That threshold's irrelevant. Because what's going to happen is the regulator is going to come in and kind of wink and nod and say, you know what? It'd be a good idea if you kind of comply with these things because you know what's going to happen. It's all going to roll downhill. You guys have got a problem from the standpoint of perception of your rules and regulations and the way you administer those. And the cost that's involved is prohibitive for the banks to continue to do this. I see the small banks in my area. They're one by one falling and being merged with other ones because they can't keep up with what's going on. And then when they try and merge and try and salvage the stuff, it's very difficult for them to do that. I had one bank in my district that failed over 2 years. That's untenable. Cannot happen. So I guess my question to you is, do you ever go back after you've merged these banks and take a look at the communities and the effect that the merger had on the communities?
Well, we certainly examine these institutions, and to the extent that it's
I didn't ask whether you examine the institutions. I know the examiners show up and look at the new merged bank. But do you ever go back and look at the area that was, and you have 2 communities, for instance, and a bank merged over here into this bank over here. Do you ever go back and look at this other community, see how it's been affected?
Well, We certainly do, as I said, we examine these institutions, we examine them for CRA and the like, so I think we do.
Do you make sure that the surviving bank actually is fulfilling its commitments to do whatever you did in the merger agreement?
I think one of our goals would be to ensure that ultimately the
I didn't ask you as a goal, Mr. Anderson. I asked if you do it.
we do it through our examination process, yes.
You do through examination process. Well, it's very concerning to me because I think if you don't understand the effect, and Mr. Posey asked the question whether you guys have ever been in a bank yourself. If you don't understand the effect of what's going to happen with your decisions, it's very frustrating to me to see here that you're making those kind of decisions and really don't have any way of following up on them and seeing if you actually did the right thing. Mr. Chairman, I yield back.
Gentleman yields. The gentleman from California, Mr. Sherman, is now recognized.
Back in the summer of 2021, very early in the Biden administration, he signed an executive order saying that the four agencies dealing with bank mergers, the DOJ, the Fed, the FDIC, and the OCC, two of which are represented here, should provide updated guidelines and regulations for approving bank mergers. And yet here we are. The two agencies before us here have at least issued proposed regulations. The other two, your two partners, aren't even here to explain why they haven't done anything at all, at least as far as publishing proposed regulations. The ranking member led 15 House Democrats in urging all four of you to move forward quickly. What is the state of progress with regard to issuing new merger guideline policies, and when do you think your agency is going to turn its proposed regulations into final regulations? Go ahead.
Well, Congressman, our proposed SOP is not a regulation, right? It's purely a statement of policy. And so
Okay.
We are, it's proposed.
But is it a proposed statement of policy?
It is a proposed statement
Proposed.
of
So when
policy.
do you go all the way to a statement of policy?
Well, our hope is that that we will get comments over the next 60 days, and that we will eventually finalize that statement of policy as we move forward. We don't have a specific date in
And do
mind.
you need to wait for the three sister agencies to act before you have a different approach?
With respect to our statement of policy, we do not.
Okay, and I'll ask our other witness. When are you going to have a final statement of policy or regulation?
So let me start by saying that we are aware of the executive order. We take the executive order very seriously.
Yes, I know. Please get to my question.
Pardon me. The
When are you
question
going to
is
have
when?
it done?
So obviously there's a process. So we have issued.
When are you going to get it done?
So the comment period runs until the middle of June, if I'm remembering correctly, approximately mid-June. We will go through the APA process of evaluating
Okay.
comments.
When are you going to get it done? Just a date, the time, a month?
It
A year.
It is a function of the administrative
Okay, I'm
Procedures
going to
Act
go on to
process.
another question.
But
I'm reclaiming my time. I'm going to go on to another question. Usually we deal with bank mergers. This is in a way a credit card processing merger. Visa's $2.4 trillion in transactions, MasterCard 1.1, American Express a little under 900 billion. Discover is much smaller, $182 billion, and not a real competitor to the triopoly. Has Capital One committed, I mean, we've learned in New York in dealing with scandal sheets and newspaper tabloids, this whole idea of catch and kill. Has Capital One committed in a legally binding way that they are not trying to capture and kill Discover, that they will not just move the Discover people over to Visa or MasterCard and eliminate this potential competitor? Do either of you have an answer? Yes, Ted?
So I'm happy to start and then welcome Mr. Anderson.
I think it's a yes/no question. Have they made the commitment or not?
I am not in a position to comment on any pending application before the OCC, but in general, we will look at all of the statutory and regulatory factors, including questions that are on point with the, including the factors that
Okay.
are on point with the issue that you're posing.
Okay, I'll ask the other witness.
Congressman, the application that you're talking about is not before the FDIC, so I actually can't comment to that.
Gotcha. You folks are bank prudential regulators, so it's in your DNA to see whether the banks are successful and healthy and profitable. To what extent can you balance that with your other objective to make sure that merchants and consumers are getting a fair deal? Can you do that in the scope of being an agency where 99% of the people you work with are focused on bank prudential security? Mr. Dowd?
I think the answer is yes. I think we can balance those interests. We do so in each Bank Merger Act application through going through those statutory factors. So
I would urge all the bank regulators who look at this to make sure that we don't lose this as an opportunity to turn Discover into a real competitor in this space, or at the other extreme, see it eliminated as even a potential competitor. And I yield back.
Gentleman yields. Gentleman from Texas, Mr. Williams, is recognized.
Thank you, Mr. Chairman. Thank you for being here today. When people hear the word merger, they automatically think something bad, but mergers can be good for the banking industry. Mergers are a sign that banks are providing to the financial needs of the customers and communities they serve. Mergers can help banks become more effective competitors, generate cost savings, and promote healthy competition and robust banking system. However, on the other side, mergers sometimes conducted out of necessity, such as when banks can't afford the expensive compliance costs that come along with burdensome regulations, which forces banks to consider mergers in order to spread these regulatory costs over a wider book of business. So this threat of overwhelming compliance costs due to the regulatory cliff effect ends up hurting regional and community banks who are put under pressure to merge when they are subject to enhanced capital and liquidity requirements from the federal banking agencies and financial regulators. So, Mr. Anderson, can you expand on what the FDIC is doing to address the anti-competitive effects of burdensome regulations for small community banks and what the FDIC can do to mitigate the potential negative effects that its proposed changes to its merger review framework may have?
well, as you mentioned, we have an obligation under the Bank Merger Act to look at the competitive effects of any merger. We look at that from the geographical and product markets. We take a look at the other competing entities in those marketplaces as well. We take a look at deposit concentrations as a proxy for bank services, but we also look at other services. So I think we ultimately look at those competitive factors and try to address the concern you just raised.
Yeah, regulations are killing community banks, in case you don't know that. I continue to hear from banks in my district that regulators are slow to review merger applications and that the review process lacks a clear set of expectations, and we've talked about that today. Bankers do not want to have to devote time, money, and resources to pursue merger when the approval process is just going to be dragged out and delayed by regulators. The role of the federal regulators should be to improve the merger process, not to make it more burdensome for the institutions applying. So, Mr. Anderson, again, what is the average time the FDIC has to review a merger application?
So I can't speak to every year. I can say that, last year the average time was approximately 109 days once the application was received. I think potentially a better measure there is terms of when an application is deemed substantially complete, which is typically around 68 days has been the turnaround time. Our goal is to hit 60, to do that in 60 days on a typical case, and we meet that goal approximately 60% of the time. We did that last year and as well as the year before.
All right, now in July of 2021, President Biden issued an executive order that would create a whole-of-government approach to competition policy. This is counterproductive, and just as we've seen with the regulatory regime of the Biden administration, more government involvement in the free market does not work. So under this executive order, banking regulators were tasked with updating their guidelines on banking mergers to provide a more robust scrutiny of the merger process. So the FDIC and the OCC have been both published their updated guidelines, both of which do nothing to benefit bank mergers. The OCC's proposal does more harm than good by removing key provisions that would streamline and expedite the application and review process, further clogging the already increasing backlog of applications. Now, while the FDIC's proposal would discourage mergers altogether, further disadvantaging banks and the customers they serve. So putting aside the damage these damage proposals will do on their own, it's shocking how different they are from each other. So depending on the structure of proposed merger, an applicant could have to get approval from multiple banking agencies, and if these proposals are adopted, banks may have to try and comply with conflicting merger review regimes. So in closing, and that would lead to significant uncertainty. So Mr. Dowd, for you, as the OCC considered the damage, confusion, and regulatory burden they could be placed on banks, by having to follow conflicting guidelines from multiple different regulators?
I'm sorry, I didn't understand the question.
Okay, here it is. I'll do it again, okay? Mr. Dowd, has the OCC considered the damage, confusion, and regulatory burden that could be placed on banks by having to follow conflicting guidelines from multiple different regulators?
The OCC considers all aspects and potential implications, both positive and negative, when we propose to implement new rules, guidelines, policies. We consider it on balance. So, thinking about a merger application that is front of the OCC, in the abstract, we don't think about it as positive or negative. It is the attributes of that application that are important to the OCC.
Okay. I yield my time back, Mr. Chairman.
The gentleman from Georgia, Mr. Scott, is now recognized.
This is a very important and a very timely hearing. And Mr. Anderson, under the proposed rules, lenders with more than $50 billion in assets would now face FDIC hearings examining whether a merger was in the public interest. Is that right?
That is the proposal, that we would have public hearings for mergers that would have
While those with combined assets of $100 billion would have to clear more stringent hurdles to ensure that they do not pose a risk to our financial system. Is that right?
That is the way the proposal is written at this point, yes.
Well, today, 47 banks in the United States, out of more than 4,500 banks, have over $50 billion in assets, and 32 are above $100 billion in assets. So my question to you, Mr. Anderson, is this. What is the evidence or indication that the current financial environment or pressures on earnings or of some of the U.S. regional banks could lead to prolonged concentrations in our banking sector?
So that's a very complicated question. I think that's probably a question that the economists would probably be in a better position to answer.
Well, let me ask you this. Can you express with full confidence that all banks above $50 billion in assets have access to sufficient liquidity to guard against unexpected deposit overflows from uninsured depositors?
I'm not in a position to commit to that. Again, there are probably people at the FDIC that are better positioned to answer that question, sir.
Also, Mr. Anderson, in your testimony, you referenced the FDIC's merger review. That would be broad in nature, and that the FDIC would consider the record of each institution in complying with consumer protection requirements and maintaining a sound and effective compliance system.
That is correct.
As you are aware, however, when banks publicly express that they are exploring a merger, time matters. Uncertainties about progress, outcomes weigh on our customers, local communities, employees, shareholders. So my question to you is, how can the FDIC assure our banks and the public that regulators will make decisions that are in the best interest of everyone promptly and fairly?
I think that is what our proposed SOP is actually getting at. It is trying to lay out exactly how the FDIC reviews the statutory factors. It also is laying out the type of information that we would need from those institutions to be able to move quickly, So I think that's really the goal of the proposed SOP. And I think if we were able to move forward in that space, I think we'd be able to make those decisions in the manner that you just mentioned.
Well, let me ask you this, Mr. Anderson, just how will the FDIC demonstrate that a bank merger, subject to its approval, will result in an institution that is positioned to better meet the convenience and needs of the community it serves? Can you express?
Well, as you mentioned, the statutory factor requires that we consider the convenience and needs of the community to be served. The proposed SOP talks about hoping or wanting to have an institution, a resulting institution that's going to better serve the community. We would look at their CRA rating at the end. We would look at the products and services that they would be offering. That could be achieved through higher lending limits or other new products and the like. And so those are things that we would consider as we move forward.
Thank you, Mr. Anderson.
Thank you.
The gentleman from Georgia, Mr. Loudermilk, is now recognized.
Well, thank you, Mr. Chairman, and thank you to our witnesses for coming to testify today on behalf of your respective agencies. Like many of my colleagues, I'm concerned that the banking regulators have taken aggressive steps to discourage mid-size and community banks from partnering with fintechs to keep up with technology and meet customer and regulatory expectations. At the same time, the FDIC and OCC have proposed revisions to the bank merger review process that we're here to talk about today, which I suspect will hamper banks' ability to leverage economies of scale and the technological expertise of other banks to fill the gap created by the hostile regulatory treatment of bank fintech partnerships. So, Mr. Anderson, could you briefly discuss some of the challenges community banks face when trying to keep up with technology and meet the regulatory and cybersecurity practices expected of them?
Well, we're certainly aware that those things are costly to community banks, and we take those things into account, if you will, when we are looking at a bank merger transaction. So we're aware of them. Obviously, to the extent that community banks want to partner with third parties, that's certainly appropriate, provided they're doing so in a manner that ultimately allows the institution to operate in a safe and sound manner. So we're certainly aware of those concerns.
Okay, well, that's good to know. I mean, when you compare the regulatory burdens that are put on a small institution versus a large institution, it's clear to see that when a larger financial institution has as much as one or two floors of just regulatory specialists or compliance specialists versus a small two-branch community bank who may fall under a similar set of regulations, it's much more difficult on those banks. With that in mind, do you think mergers might allow banks to gain the economies of scale to make capital-intensive technological investments?
They can. That's possible.
So does the FDIC view bank fintech partnerships as beneficial to mid-sizes and community banks?
They can be.
Okay. Do you believe the FDIC is, or at least strives to be, a politically independent regulatory agency?
I do.
Okay. Mr. Dowd, do you feel the same thing about the OCC, that is politically independent?
I do.
Okay. Well, that concerns me a little bit, as contrast, Mr. Dowd, to something that you said to one of my colleagues earlier regarding the executive order by the president, which encouraged federal banking agencies to reexamine their policies on merger reviews under the Bank Merger Act and Bank Holding Company Act. As far as I'm aware, prior to this executive order, the agencies hadn't given any indication that they were contemplating changes to the merger review process. So what I may derive from your previous answer was Executive Order 14036, a contributor to the OCC's decision to reassess its merger review process.
So I would say that the OCC is always looking at the business of banking, and in particular, the evolution of the business of banking. So when you get to the organic statute that the national banks and the OCC operate under, 12 U.S.C. 24/7, national banks may engage in the business of banking. And Obviously, the business of banking today looks very different than it looked 10 years ago, 50 years ago, et cetera.
But more specifically, from what I understood in the answer you gave earlier, that there was, the executive order was kind of a catalyst, or you were giving attention to the executive order. What I'm asking is that executive order one of the primary reasons that you're reassessing this?
I would say the executive order and the landscape of the delivery of financial services and the landscape of the banking industry are all things that contribute to an OCC decision to think about bank mergers and how we approach bank mergers. I mean, fundamentally, if you look at the way that the agencies have approached it, there hasn't been meaningful change since 1995.
Well, I think you're kind of skirting the question here. Let me ask Mr. Anderson the same thing. Was Executive Order 14036 a contributor to the FDIC's decision to reassess its merger review process?
Congressman, we were certainly aware of the executive order. I think from the FDIC's perspective, our statement of policy on bank mergers had not been updated for a number of years. As Mr. Dowd suggested, the banking landscape has changed dramatically, and we frankly thought it was appropriate to take a look at our bank merger policy.
Well, it's very suspicious that both of your agencies decided to take this on after that was made public. I see that I'm out of time, so Mr. Chair, I yield back.
Gentleman yields. The gentleman from California, Mr. Vargas, is recognized.
Thank you very much, Mr. Chairman. Appreciate it, and of course, the witnesses for being here. Seems like a lot of the questions that you're receiving today, you're getting from the dais up here, are questions really that go to economists, not so much regulators, prudential regulators. But since that's what we're doing, I'm going to ask a few of those myself. When the chairman brought up the metaphor of the clock, the amount of time that you would have in basketball, the shot clock, Mr. Dowd, you seem to have a moment of joy today. First one, maybe only one, because you seem to know about the Wildcats and you seem to know quite a bit about the Knicks or someone behind you. But he actually mixed his metaphor because he spoke about basketball, but he also spoke about purgatory. I'm not familiar with purgatory in basketball, but I am familiar with purgatory in Catholicism. Purgatory is not a bad place. Everyone thinks that purgatory is a bad place. If you're a Catholic, you know that purgatory is not a bad place because it assures that you're going to get to heaven. Purgatory is actually a very good place. You go to purgatory to expiate for your moral failings or for your sins. However, if you have a grave or mortal sin, you can't atone for that in purgatory. You actually go to hell. So that's why purgatory is good, because it means you only have venial sins. So when he said that there's this time clock, and I don't know how far I want to push this analogy because I'm just thought about it today, but it just seems that if you do have a merger or an acquisition and you put them in purgatory, that's not necessarily bad because they still have the opportunity to merge. They still have the opportunity to accomplish what they want to do. So with that being said, I do want to know how you take into the community, how you take in the needs of the community here, especially through public comment. Because again, purgatory can be very quick, or it can be very long, depends on the number of sins. So again, would you please comment on that?
Sure. Let me start by saying that I'm always happy to talk about basketball, but I can see this is not the forum to talk about basketball, so I will leave shot clock analogies to the side. Your question about community involvement, I think, is an excellent question, and it is a question and it is a process that is critical to the evaluation of a merger application that is before the OCC and how the OCC approaches that merger application. So built within the process, under the statutory factor of convenience of needs, the OCC is required legally to consider the convenience and needs of the community with respect to the impact of or a potential impact of a merger transaction. So diving into that, what does that mean? that means we are very interested in the views of the stakeholders, the consumers, the potential consumers of the resulting bank. So when we have,
Well,
when we have a merger application, as I mentioned in my testimony, we put that up on our website. We solicit public comment.
But if I could interrupt you just for 1 second, because I think this is the point that I was trying to make, the difference between an economist and a regulator. Because you take a look at the individualized decision in front of you, just the bank. You don't take a look necessarily at the other banks or community in the area, I don't think. I mean, there's some unfairness to look at the community itself and say, okay, we're not going to allow this bank to merge because of issues going on in that particular community. I know you take them into account, but that's not necessarily the largest question here that you have to settle. And the reason I say that is because economists will take a look and say that there's too few banks now, because these mergers and acquisitions have consolidated them in such a way that there isn't the market competition that you need. But you guys are looking at the banks individually. You're not looking at them as a system. And it would be unfair to look at them as a system when there's a particular application before you. In fact, you can't even talk about the particular application in front of you because you say that's unfair because it's before us. Well, that is the case. I mean, I think that is the problem that we're looking at. How do you solve the larger problem? And that is something I think an economist would have a better answer to. That's why I think it's a little difficult for you guys here. My time, maybe you could answer that in writing. Mr. Chairman, I yield back.
The gentleman yields, and the gentleman from Tennessee is recognized, Mr. Rose, who may be able to explain what he witnessed in terms of regulatory purgatory in Tennessee.
Thank you, Chairman Barr and Ranking Member Foster, for holding this hearing, and thank you to our witnesses for being with us today. I don't know anything about purgatory, but I do know that my Lord and Savior, Jesus Christ, died on the cross to answer for my sins, and if you believe in Him and have faith in Him and repent, you can enjoy that as well. So thank you again, gentlemen, for being here. I'd like to start by discussing some of the challenges that community banking organizations face. Mr. Anderson, what has the Federal Deposit Insurance Corporation found in their analysis of community banking organizations, and specifically their ability to keep up with technology to meet the growing regulatory expectations, to maintain cybersecurity, and compete for customers?
I mean, I think it's fair to say that it's a very competitive market. We recognize that there are certain challenges that community banks face, given their size and their ability or inability at times to grow scale. So those are certainly things that we're aware of, and we try to factor in as we supervise those institutions.
And speak to, and I wonder, do you think that mergers are an important pathway to allow these banks to gain the economies of scale, frankly, that are necessary to meet these capital-intensive technology investments that are required by the changing landscape and by the changing regulatory landscape?
In certain circumstances, they can be.
All right. I would like to shift now and discuss the situation that community banks actually face, which is a dragged-out merger review and approval process. Delays in merger approvals come with many risks, in my view, not the least of which are cybersecurity vulnerabilities. While a merger is pending, technology investments naturally wane, and companies may see the departure of key employees who manage cybersecurity risk. If a bank must wait several months for approval, it becomes vulnerable to cyber attacks, frankly putting its depositors at risk. Mr. Dowd, when the Office of the Comptroller of Currency decided to remove streamlined applications and expedited merger reviews in its proposed rulemaking, was there any consideration given to the fact that depositors were potentially being exposed to cyber criminals?
So let me start by saying that national security is extremely important to the OCC. And a bank's ability to comply with BSA and AML requirements and laws is paramount to our supervision of the federal banking system. To the extent that we have an application in front of us that raises questions or presents issues with respect to a bank's ability to comply with BSA and AML requirements, that is something that we take extraordinarily seriously.
Mr. Dowd, I can't help but observe, and it's my view of this new rulemaking and new approach to mergers. My first boss was pretty exacting, and he always was on to me because I always gave him excellent work and prided myself, I'm a recovering lawyer, I will say, prided myself in getting to the right answer. But he pointed out to me once after waiting a long time for the right answer that time is an element of quality, and that on that I had failed. And so this is my criticism of this process is that, and I'd like you to respond to it, is that delayed time, even if you are getting to a perfect answer, makes that answer, frankly, imperfect. And that's really what I'm trying to get at. And I wonder if you might respond to that, and what impetus is there for you all to do this in a timely fashion?
Well, I agree completely that timely responses is part of a critical part of being an effective lawyer. With respect to the particular issue we are discussing, I think it's important to marry the first piece of what I said with the policy statement that is attached to the OCC's NPR. And in that policy statement, we, the OCC, identify features that are consistent with a timely decision on a bank merger application. There are a list of them. I won't bother to read through all of them. But critically, on that list is that there are no Bank Secrecy Act issues, and there are lending issues, no CRA issues. But with respect to BSA AML, if an application comes in and it's clean, we are prepared to act in a timely fashion with respect to that piece of it.
I thank you, and I see my time's expired. I do implore you to move as quickly as possible in this process. Thank you, Mr. Chairman. I yield back.
The gentleman from Illinois, Mr. Caston, is recognized.
Thank you, Mr. Chair, and thank you to our witnesses. So I'm going to, I guess I have some high-level questions and observations, and hopefully you'll agree with my observations on the front end. I'm broadly, very supportive of stringent review of merger and activity for financial stability reasons and for antitrust reasons as well. As I think about your jurisdiction, as you look at a merger, it strikes me that both of you are primarily focused on banks being able to carry out their functions, whether AML, as you've mentioned many times, or the stability of the bank and the banking system, and to somewhat lesser degree, the antitrust questions, which I think sort of tip into DOJ jurisdiction. And I guess what I'm wondering is, all of our discussion today has been focused on your narrow jurisdiction. To what degree are you coordinating with DOJ or FTC or other antitrust authorities when you make these decisions, just at a high level?
Well, on a high level, on any merger, we have to get a report from the Department of Justice, so we coordinate with them in that manner, if you will. But we do have to make our own independent determination, if you will, on those competitive concerns.
Okay, and they would have to sign off as well before your process is done?
We have the authority to move forward on our own.
In all cases?
In all cases.
Okay. So maybe that then gets to the two scenarios that I'm struggling with in my head. You've got one which always gets the press and the news that there's an emergency sale. It's SVB, it's Signature, it's Merrill Lynch, Lehman, and all of a sudden there is a big bank with a robust balance sheet, and you got to move quickly to get in. And then after the fact, we say, well, did this lead to greater banking concentration? That's one set of questions that strike me where you have a tension between your obligations from a stability perspective and how you think about antitrust. And I guess what you're saying is you can make that decision unilaterally. Would you ever make that decision and say, once the dust settles, we've got to go through and separate this back out to avoid some of the industrial concentration questions that it raises?
I'm not sure how I would answer that question. It's a fair question. That's something I'd have to think about.
I mean, because the implication there is that antitrust is ignored in the moment, and may be appropriate to be ignored in the moment. Like maybe there only is one bank that has the liquidity to carry this out, but it sounds like there's never an example where you unwind it afterwards.
Well, I think you're talking about an extreme situation when you're talking about a potential failure, and that certainly raises a number of different issues that indeed, some of which you've raised. So that's, again, I'd have to think a little bit more on that, on the question itself.
Well, so that then gets to the second scenario that I'm struggling with a little bit, that as you look at existing networks of mergers that are, some of that we've talked about in this hearing, others that, we don't know about yet, but someone's going to announce next week and you'll have to get your pens out again. I think the size of all those mergers, from an asset concentration, from a deposit concentration, whatever you want to measure, pales relative to the growth in deposit base of the, JP Morgan and Bank of America. And so from a concentration perspective, the organic growth in those banks seems to dwarf what's happening on the merger side. And I don't say that in any way to suggest that you shouldn't be vigilant on the mergers, but how do you deal with a scenario if you're saying from a purely antitrust perspective, the factors driving concentration are not issues that would trigger a review on your part, right? But on the other hand, the factors that are creating scenarios where someone might be a competitor to those large players do trigger review. How do you think about that from an antitrust perspective?
Again, that's a very interesting question. I'd have to get back with you on that. I'm sorry.
I will be the guy guilty of asking interesting questions. I would love to know how you think about those, because I just, to come back to where I said at the start, I think there is a tension between short-term stability and antitrust measures. I want to believe that our regulators, and the coordination across the regulators is doing that trade-off. Because if you're not, then it's on us to figure out how to do it. And I mean, don't get me wrong, some of us are really smart. but I want to make sure that the people who are down in the weeds are in the lead on that. I'd welcome the chance to follow up with you offline and yield back. Thanks.
If you provide that question to us, we'll certainly talk.
The gentleman from Wisconsin, Mr. Fitzgerald, is recognized.
Thank you, Mr. Chairman. Some of these may be a little redundant, but rephrased, and Mr. Posey's question about whether or not you gentlemen ever worked in a bank, I think, is significant. It's become more significant because I'm having a really hard time here this morning understanding how hands-on this process is, if it's hands-on at all. But as we know, mergers require significant upfront and ongoing investment and the commitment of resources. And that includes kind of finding a target, conducting due diligence, and negotiating the terms, right, of the transaction. Once a target is identified, the banks have to prepare the appropriate regulatory filings, engage with regulators, and prepare for post-approval business process. So given all the upfront work that happens in a merger, it should come as no surprise that few deals are really blocked because everything is kind of in order. So let me ask you this. Does the FDIC and the OCC currently believe the lack of denials of bank mergers means that the framework is working, or is it clearly ineffective at this point? And Mr. Anderson, I'd ask you to go first on that.
I think we believe our framework is working. I mean, I think ultimately we are evaluating the statutory factors and coming to conclusions on that. Our process is such that to the extent that a merger is not going to meet the statutory factors, it's a very iterative process. We would talk to the institution and frankly let them know that we would be recommending potentially a denial, and in many instances, institutions withdraw. But I think overall, I think we believe that our process is actually working.
Mr. Dowd?
Thank you for the question. It's a very good question, and a question we should be asking ourselves on a regular basis. I agree with Mr. Anderson. The process is working, but I also recognize that there is always opportunity for improvement and refinement, and that is the exercise that the OCC is engaged in right now, and one that I would suggest that all of the federal banking agencies and the Department of Justice should engage in from time to time.
So I don't think there's any doubt that the consequences of the delays, the merger delays, has a significant impact on the banks involved, right? Causing greater operational risk, certainly expenses are going to increase as there's a delay. And then the reputation of the bank. I mean, if you're a customer of that bank, and we know how this works, that, you know, there's kind of this rumor mill that starts, and who's going out of business, who's going to remain in business, am I going to have to switch accounts, am I going to have to get a new debit card, I mean, all these things happen in this process. And this is not just a problem of the big banks. It's obviously, as smaller the bank, it's probably more significant. So the uncertainty in the merger process, it limits opportunities, I would say as well. But the banks just can't simply hit the pause button. They must continue to market their services, you know, market their brand, make sure that they're still in business. It's a business, right? So how do you consider the cost of delays? Have you looked at these? Have you examined these and said, this is a problem for us if it's having that type of impact on banks across the country? Mr. Anderson, I'd ask you if you guys have looked at this or not.
Well, we're certainly aware that at times applications have not moved as quickly as we would like. I think that part of the proposed SOP and the updated Bank Merger Act interagency application form that we put out for public comment as well, part of that is to make it clear how we're going to evaluate the statutory factors, as well as to let institutions understand, if you will, the type of information that we need to make a decision. And so I think ultimately our hope is that combining those two will come out with a more efficient process and be able to move some of those applications faster.
So is there any, Mr. Dowd, I'll ask you this, is there any sense of expediency? Is there any awareness of the impact you could be having on a bank if in fact this work can't be done and done quickly?
We are keenly aware of the issues that you have raised. On the spectrum of small institutions, we process those in general very quickly, very efficiently. With respect to the larger institutions, those transactions are more complex, and complexity drives timing. For a clean transaction involving large banks, we have the ability to move very quickly, and we are, again, keenly aware of the benefits and sometimes the need to move quickly on that front. But a lot of it is dependent on what comes in on the application. And to the extent that an application arrives that introduces potential safety and soundness and risk concerns for what would be the resulting
The gentleman's time has
institution,
expired.
we want to ensure that we are on top of those so that the ultimate institution that is approved.
The time has expired. The time has
My
expired.
apologies.
The gentleman from Massachusetts, Ms. Presley, is now recognized.
Thank you, Mr. Chair. Today's subcommittee hearing is entitled Merger Policies of the Federal Banking Agencies. You know, the world of bank mergers and acquisitions really may seem abstract for the everyday consumer. So I just wanted to just dial in like why this matters. The lack of bank competition has real impacts. It directly affects the interest you earn on your savings account, your monthly mortgage or your car loan, ATM fees, credit affordability, to name a few. And for workers, it is well documented that bank mergers often lead to bank branch closures and job losses. It is well past time for bank regulators to review bank mergers through an antitrust lens and with a consumer protection perspective. Failure to do so for decades has lined the pockets of bank executives and shareholders, while the American public, whether urban, rural, or suburban, has suffered and seen costs rise. In 1994 in the United States, there were over 14,000 banks. Today, in 2024, 40 years later, there are just 4,000. And the 6 largest banks control more than half of total assets. This decline is not a coincidence nor happenstance. Rather, it is a direct consequence of bank regulators' failure to enforce antitrust laws in the banking sector. From 2006 to 2021, the Federal Reserve reviewed over 3,500 bank mergers and approved every single one of them. This series of policy choices has weakened our financial system, caused consumer harm, and reduce competition among banks. Mr. Anderson and Mr. Dowd, since bank mergers in so many cases have proven to harm consumers with higher prices and more fees, lower deposit rates, less access to credit, bank branch closures, which I care about. I represent a district in Massachusetts, the city of Boston. There are 10% of my constituents are unbanked, 20% are underbanked. So there are bank branch closures and job cuts. What steps are the FDIC and OCC taking to ensure customers, especially those from communities of color, low and moderate income communities, to ensure that they are not getting the short end of the stick?
It's a fair question, Congresswoman. I think that as we analyze the Bank Merger Act factors, the primary ones that you're talking about are the effects on competition and convenience and needs of the community with respect to branches and the like, and to the extent that those merged entities are serving low and moderate income communities. I think as we look at what the resulting transaction is going to look like, we're going to look and try to ensure that ultimately those services are carried through. We look at the business plan of the resulting institution over 3 years to take a look at the branches that they are suggesting they're going to close as well as open. So I think ultimately we would be looking at those concerns in the resulting transaction.
All right, Mr. Dowd, while I appreciate that the OCC issued its proposal to strengthen bank merger reviews in January, some experts have said that your proposal is not as strong as the proposal that the FDIC issued. Are you concerned by the differences in your proposal from the FDIC's, and is your agency open to incorporating reforms put forward by the FDIC in their own proposal?
The OCC is open to receiving comments from all stakeholders who are affected or have an interest in our NPR. So that would absolutely include consumers of banks, community groups, all of the communities and people that you have identified. And we welcome those comments. We want those comments. Procedurally, it is a notice.
I have one more question I want to get in on the record. Apologies for interrupting. My time is lapsing here. Mr. Dowd, can you speak to how the OCC is considering financial stability in merger reviews?
It is one of the statutory factors that we are required to consider. We do consider it consistent with our statutory obligation, and we coordinate with our peer regulators at the Federal Reserve and when appropriate with the FDIC. I will say, at a technical matter, there are often numerous legal entities involved. So we'll work with the Fed on the holding company piece.
All right. Thank you.
Gentlelady's time has expired. All right. The gentlelady from California, Ms. Kim, is recognized.
Thank you, Chairman. Thank you to our witnesses for spending time with us this afternoon in our subcommittee. You know, my concern is that there is no consistency in the bank merger review process, and the methods for approving or disapproving are very opaque. I want to ask a question to both of you. Will you please describe the efforts that your respective agency is doing to improve predictability, transparency, and efficiency in the merger review process?
So I think that's the very purpose of our proposed SOP that's out today, or that's out now. It's really to lay out how the FDIC approaches each of the statutory factors, and for lack of a better way to say it, to provide some meat on the bone, if you will, so that people can understand how we do that. It's also an opportunity, if you will, for us to make it clear the type of information that we're going to want from applicants who are seeking to merge. So I think those are the steps that we've taken.
Sure. Mr. Dowd.
Yeah, I agree with that, and I will say, at its core, that is what the OCC NPR and policy statement is after. So we're looking for ways to improve transparency and predictability with respect to bank merger applications and how they're processed. And to that end, again, if you look at the policy statement, we identify features that if you have these features, that those are consistent with a timely decision on a bank merger application, If you are deficient in one or more of those features, that is going to require and necessitate more time to ensure that we are, if we are approving an institution, that the institution that we are approving ultimately has the financial and managerial resources, systems and controls, et cetera, to operate in a safe and sound manner and to serve the needs of its community.
So both the FDIC and OCC's recent proposals, as I reviewed it, seem to indicate that the predictability and transparency are not the end goals. So, Mr. Anderson, is in your FDIC's proposal, there is a requirement that the combined bank better meet the convenience and the needs of the community served by combined entities. So how will the applicants be able to predict what the FDIC considers better meeting the needs of the community?
Well, I think we've tried to lay that a little bit out in the proposal. That is certainly something new, and frankly, we're seeking comment on that, so I'm certainly interested in getting comment as we move forward. I think that we talk about in the proposal that can be met in terms of increased lending limits, new products and the like, so those would be ways in which the resulting institution can show that they're going to better meet the needs of the community.
And Mr. Dowd, one focus of OCC's proposal is on the job losses or reduced job opportunities resulting from the merger. So will OCC provide further clarity on what would be considered an acceptable or unacceptable job losses?
So again, it is a notice of proposed rulemaking. So I can't predict where a final rule will go. I mean, obviously, the Administrative Procedures Act has rules on what we can say, and more importantly, we don't want to front-run the process. But the issue you raise is a very good issue, and we would welcome comments on that point, and we will take those comments very seriously when we decide how we construct and shape a final rule.
Thank you. You know, we're still seeing the ripple effect of record high inflation and high interest rates, and we saw it with SVB and First Republic last year, and we're seeing it with a number of other banks like Republic Bank in Pennsylvania this year. My view is that we should make it easier for some of the troubled banks to have an off-ramp before it's too late to act. So would both of you speak of the financial stability considerations that you take into account during the merger review process? And can you, do you consider the risk to financial stability with a merger when a merger is not approved?
We do consider financial stability in a merger application. It is statutorily mandated that we consider financial stability. So in that vein, we consider the size of the resulting institution, the interconnectedness of the resulting institution, the complexity of the resulting institution. If there's cross-border activity, what that cross-border activity is, and also ultimate resolutability.
Thank you. I think my time's coming up, so I just want to encourage both of you to consider the risk on both sides of the aisle. Thank you again.
Yeah, good point.
I yield back.
The gentlelady yields back. Gentleman from New York, Mr. Meeks, is recognized.
Thank you, Mr. Chairman. I want to thank both of you for being here today and for your testimony. And I've been listening upstairs and back and forth. This is, I think, a very important hearing with very significant and important ramifications. When I think and look at what's going on, I generally believe that bank mergers should be assessed on its merits, on the merits, particularly the individual application put forth, and trying to determination also what's in the best interest of the consumer and on the other side. And so that way you can judge each on its merits as opposed to just, resoundingly to see also if the application meets the regulatory criteria that's outlined after a thorough review by all. And if that's the case, then it may be fair that a merger be allowed to proceed. So to that degree, I want to appreciate that the OCC and the FDIC are working to provide more clarity, because I also hear these cases, the question about clarity, which is important to a lot of folks. So clarity around what this process is, I think is very important, and by you talking to try to provide that clarity, I think that's important. Now, that being said, also from a big picture standpoint, the consolidation of the banking industry is very concerning to me. Community and regional banks play an essential role in a district like mine, and thereby affect my constituents. The diversity of our banking ecosystem is one of the greatest strengths, and when a bank branch closes and we're starting to get banking deserts in my neighborhood, the neighborhood really feels it. So let me first ask Mr. Dowd, in your estimation, what is the impact of a more consolidated banking industry, and how does this consolidation affect our communities, and to what extent are these factors taken into account when assessing a proposed merger?
So thank you for the question. Let me start by saying that I absolutely agree that a merger application should be assessed on its merits. With respect to the statutory factors that shape the consideration on the merits, convenience and needs is critical. And so, as part of that, I think we look at how financial services and banking services are delivered to a particular community. And so obviously the banking world and the financial services world has evolved in recent years, over the last year, over the last 5 years, over the last 10 years. But ultimately the question is the community getting the financial services, and do they have access to the financial services that they need, consistent with the convenience and needs factors set forth in the Bank Merger Act statute?
Let me have FDIC, what's your viewpoint?
I would agree with what Mr. Dowd said. I mean, that is something that we certainly look at as we kind of evaluate the convenience and needs statutory factor. You mentioned branch closings and concerns in communities regarding that. That is something that we would take into account when we look at an application. We look at that application over kind of a 3-year period, if you will, and try to get an understanding of what the proposed branch closings are. And as Ted mentioned, we would really want to make certain that those communities, to the extent that branches are closed, are still going to receive banking services.
Do you anticipate that this big picture dynamic will play a larger role in the final proposal of reforms of your M&A review policies?
You'd have to kind of bring me back to the big picture part that you're talking
So
about.
the big picture is trying to look at these mergers individually to make the assessments that we're talking about in regards to,
Yeah. Yes, I mean, I think we do have to look at every merger based upon its own kind of factors, if you will, and make that determination.
So let me quickly shift, because I see I'm running out of time, focus to the FDIC meeting that took place last week, where 2 proposals relating to bank control were considered. And at the meeting, I believe Comptroller Sue remarked that instead of creating opportunities for a turf battle, the prudential regulators, namely the OCC, the FDIC, and the Federal Reserve, should enhance their coordination and develop a unified interagency approach to address issues related to bank control. Mr. Dowd, I think you were there. Can you elaborate? Why is that so critical to achieve?
I apologize, Mr. Meeks. I'm not quite sure I followed the question.
At the FDIC meeting last week, Comptroller Sue remarked that instead of creating opportunities for a turf battle, people are trying to fight for the various turf, I'm seeing them out of time, the prudential regulators, OCC, FDIC, and the Federal Reserve should enhance coordination, talking among themselves, so there's clarity.
Yeah, the gentleman can respond for the record. The gentleman's time has expired. It's a good question, though, so that we would appreciate you responding on the record. The gentleman from Tennessee, Mr. Ogles, is now recognized.
Thank you, Mr. Chairman, and thank you to the witnesses for being here. As most things run by the federal government, the existing bank merger review process is slow, it's unpredictable, and opaque. I think we can all agree that it's important for bank merger policies to encourage competition, which is one of the pillars of the free market, yet not encourage increased regulations, including those required by the Dodd-Frank Act that would result in driving banks to merge to afford compliance with burdensome regulations. And I think that's one of the things to note here is that, when you look at the larger banks versus your mid to large regional banks, the compliance costs are disproportionately higher at the smaller banking and the mid to regional banks, right? But competition is vital because it naturally generates cost savings in the market that can be passed on to consumers in the form of reduced fees. My question for you all is, would it be helpful for consumers, businesses, and financial stability overall if there was increased competition with the largest banks, including the global systematically important banks, the GSIBs? Please explain, Mr. Anderson.
I think overall, more competition is a good thing. I'd have to look a little bit closer on the question, kind of in the nuances that you mentioned, but overall, I think competition is a good thing in that respect.
Mr. Dowd.
I agree wholeheartedly with Mr. Anderson. The competition is a good thing. The devils are in the details with respect to the issues you raised, but I think we're perfectly happy and would like to engage on that front.
Well, so for both of you, when you look at the regulatory regime and how it does impact your mid and regional banks, and when you look at rural areas, it is often your regional banks that are your first lender, right, your first option. How is regulation hurtful to the banking system, Mr. Anderson?
Well, I'm not certain I would call regulation hurtful. I certainly understand that compliance can be costly, and I think that's kind of what you're getting at. So I think ultimately, as we move forward, our proposal is to try to make clear with respect to bank mergers what we expect, if you will, and how we're going to view these statutory factors, and hopefully make, to the extent that we're talking about a bank merger, make those costs go down, if you will, so that because they'll have an understanding of what type of information we're going to require.
Well, but what I would like to point out is, some of my colleagues have pointed out, like, you have these banking deserts, but in some cases, it's the regulatory regime that's forcing the mergers because of the increased cost of compliance. And so, whereas, the intent may be good to try to regulate a space or an industry, in fact, it's creating more harm than benefit. And so, what's your response to that?
It's a fair point. I certainly have heard those type of concerns. I think those are the type of comments that we would like to receive as part of our proposed statement of policy. So I would welcome those comments.
Mr. Dowd? Mr. Dowd?
Yeah, I agree with Mr. Anderson. I would say that regulation can be helpful at times. It can be a positive. In fact, I would take this most of the time is a positive, but I think.
But when the regulation creates banking deserts or limits access to credit, is it helpful?
It is a very fair point that you raise. I would like to talk in more detail about what the specific regulations are and what the specific communities are that are being affected. But I think that the issue you raised is fair and valid, and the OCC in my office would be happy to engage with you on that.
Now, Mr. Chairman, you and I had spoken offline on an important point, and if I may, I'll yield you the rest of my time so you can discuss with the committee what you and I talked about.
Well, thank you to my friend from Tennessee. And last Congress, the CEOs of the GSIB institutions were before this committee, and I asked Mr. Moynihan, the CEO of Bank of America, which institution posed a greater competitor, was a greater competitor to Bank of America. SunTrust alone, BB&T alone, or Truist, a combined institution? And he said undoubtedly. His testimony was undoubtedly Truist. So mergers sometimes can create competition, not undermine competition, as that testimony demonstrated. And I think Mr. Dowd, Acting Comptroller Sue, has agreed, saying that there should be competition among large banks, and simply prohibiting mergers of banks really locks in the concentration among the existing mega banks, and I don't think that's the right answer. Good point from the Acting Comptroller. How should we reconcile that sentiment with the OCC's proposal to impose a $50 billion size trigger for the presumptive denial of an application?
Can you clarify where we said that there was a presumptive denial on $50 billion transactions?
Well, my time has expired, so you can submit your answer for the record. But it's a guideline. It's principle number 2 under your guidance that the resulting institution will have total assets of less than $50 billion. So point is your new guidance, your new proposal sets a $50 billion trigger for a presumption of a denial.
I'm happy to look at that. I'm happy to follow up with your office. I'm not quite sure I would look at it the same way as a presumption of denial, but I think your question's fair, and we'll follow up.
Thank you. The gentlelady from Ohio is recognized.
Thank you, Mr. Chairman and Madam Ranking. And thank you to both of our witnesses for being here today. Let me start with you, Mr. Anderson. I'd like to start where we can talk about enhanced security and financial stability. So with the FDIC's consideration of enhanced scrutiny of mergers that result in banks with $100 billion in total assets, can you discuss the FDIC's reasoning behind this potential enhanced scrutiny?
Not certain I would describe it as enhanced scrutiny, but I think ultimately what we're saying is that institutions over, or resulting institution that might result in an institution over $100 billion, because of the size and complexity oftentimes resulting in those institutions, they in fact may have a greater concern, if you will, as it relates to financial stability. So I think we would look at it in that light. Again, it is out for comment, and so to the extent that that's not the appropriate line, we would certainly appreciate getting feedback on that.
Okay, is this related, do you think, to the recent regional bank failures that we saw last year? And how will, if so, enhanced review promote financial stability?
Well, certainly we learned a lot from the recent failures, and indeed, it's pretty clear that institutions of that size could have a significant impact if they were to fail. So I would certainly say we've certainly learned something from that, and indeed, that $100 billion mark is, as I said, something that's out for proposal, but it's certainly something that we have to consider.
Mr. Dowd, continuing in this same vein, is the OCC considering adding a similar enhancement for mergers resulting in banks with more than $100 billion?
The OCC has a notice of proposed rulemaking and a policy statement that is out for comment. We are open and receptive to all comments, including comments that raise that issue and the threshold you put forward.
Okay, can you discuss other ways that the OCC is considering financial stability in this merger, in its merger review?
So the OCC, with respect to merger reviews and the financial stability prong of the Bank Merger Act, the OCC considers it at the bank level, and then we also coordinate with our peer regulators at the Federal Reserve, presuming there's a holding company in the transaction. There is typically a holding company in I would say there's almost exclusively a holding company with respect to the larger transactions. We are also engaging with the FDIC, and we are considering the financial stability factors that I articulated earlier. So the size of the institution, the sustainability of the institution, interconnectedness is obviously very important for us on the front. The complexity of the institution, the systems and controls at the institution in order to ensure compliance with applicable laws, and also the geographical scope of the institution, both domestically and internationally.
Okay, thank you. Mr. Anderson, I know there has been a lot of focus on mergers of large banks. I'd like to ask about the merger of smaller banks. Many recent merger deals include and produce banks in the, let's say, 20 billion to 100 billion asset range that falls short of that threshold for enhanced prudential regulations. For example, UMB and Heartland announced a deal just a few days ago that will create a multi-state bank, $60 billion bank. In many cases, as in UMB, the UMB deal, it will produce a bank that has a heavy concentration of commercial real estate loans, in some cases upward to 40%, that regulators would not allow in banks subject to the additional enhanced supervision. Do you have any thoughts on this, or should we be more concerned about this?
Well, to the extent that we're talking about, I can't talk to a specific deal, but just generally speaking, I think that As a bank supervisor who examines these institutions, we certainly were going to take those type of things into consideration, whether it's CRE loans or whatever it may be. Those are things that the FDIC and all the banking regulators take a look at in our supervisory capacities.
Okay, thank you, and my time is up.
Gentlelady's time has expired. The gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman, and I want to thank the witnesses for being here today. Mergers within the financial sector promote competition and generate a robust landscape with banks that vary in size to fit all individuals' needs. The White House and my colleagues across the aisle take a different view in which they believe bank mergers are leading to runaway consolidation and feel that the government merely serves as a rubber stamp to these transactions, when in fact the process is already quite strenuous. The new proposals levied as a result of Executive Order 14036 are only going to make the merger applicant process more opaque than it already is, creating unnecessary strain on compliance departments and the workforce. Instead of streamlining an already difficult process, it appears your agencies are seeking to make it more difficult. Mr. Dowd, as part of its proposal, the OCC proposes eliminating the expedited review process. Would you explain why simple mergers or acquisitions that pose no competitiveness or other risks could not be adequately reviewed in an expedited manner?
So thank you for the question. It's a good question. For simple transactions, the OCC does process those transactions on a timely basis, on a quick basis, and I would expect that to continue. I think what the NPR does is it tries to put a little more color and contour around those transactions that are for lack of a better description, simple, vanilla, do not raise significant supervisory issues, and affirms that those transactions can be handled on a timely and quick basis. What the other part of what the NPR does, and specifically in the policy statement, is it identifies features with respect to transactions that are features that if they are not met could lead to, and will lead to enhanced review. So, for example, an application.
I just want to be clear. Are you eliminating the expedited review process, or are you not?
I think the best way to think about it is it's being reframed, and it is being explained in more detail.
Okay, I appreciate that answer. I'm not really sure I understand it, but might have some follow-up questions. I appreciate the fact that your agency's proposal contains a statement of the OCC's general principles for merger reviews, including 13 indicators that are positive in applications that the OCC would generally approve, and 6 negative indicators in applications that the OCC would generally deny. Keeping it high level, could you please give me a few examples of positive and negative indicators and explain the rationale behind it?
Sure. So let me start with the rationale, and we can go to the factors. So the rationale is, what is the resulting bank at the end of the transaction? And if the resulting bank is an institution that we have looked at in the application process, and we are confident that the bank coming out at the end of that transaction can operate in a safe and sound manner, can comply with applicable laws and regulations, is able to meet its fair lending needs, has a CRA program, et cetera, clean, then that is the type of application that is consistent with timely processing. On the other hand, if you look at any of those factors, for example, if there is a fair lending issue for one of the banks in the transaction, if there is a BSA AML concern with respect to one of the banks in the transaction, that warrants heightened scrutiny, because ultimately what you're looking at is the safety and soundness of the institution coming out at the other end.
Thank you for that. Mr. Anderson, unlike the OCC, the FDIC does not clearly list the indicators it considers when approving mergers in their latest proposal. Why did the FDIC decide on this approach, and could you discuss how your indicators compare and contrast to the OCC's?
I think that what we tried to do is lay out how the FDIC is going to approach the statutory factors, as well as lay out the type of information that we want from proposed applicants. And so I think we're trying to put a little bit more meat on the bone so that the applicants understand kind of how we're going to view those statutory factors on a go-forward basis. And I think ultimately we're hoping that the combination of that plus the information that we're going to receive will provide for a more efficient process.
Thank you for that. Mr. Chairman, I yield back.
Gentleman yields. The gentleman from South Carolina, Mr. Norman, is now recognized.
Thank you, Mr. Chairman.
You know, I had one of my questions, type for me, one of the questions was, do mergers, do regulations affect mergers? I can tell you right off, they do. I was on a bank board for a number of years, and we couldn't merge. This is when the bank failures were taking place, I think 15 years ago. TARP was in effect, and we couldn't buy banks and provide banking services because regulations, it was going to cost, in personnel cost alone, to administer the the regulations. It has only gotten worse since the Biden administration has been in office. What is the average time that you would say, assuming you have all the documentation, to review a merger application?
So I can't speak for every year at the FDIC. I can say that in 2023, the average time from the point in which an application is deemed substantially complete has been approximately 68 days. In 2002, that was approximately 59 days.
Mr. Dowd?
Thank you. I do not have that data in front of me. I will say in general, for transactions that involve smaller institutions, our turnaround time is quite quick and efficient. For larger, more complex transactions, it can take longer, but I'm happy to follow up with your office with more detailed data.
Would the best way for us to be, and I understand that, you know, y'all need specifics to go by, if we write you a list of concerns that we have with regulations that are in place for you to respond to and I guess give a rationale for why they're in place, because time's money in banks, and I've had banks in all this week that are very concerned about the time for bank mergers that it takes to review, and that it's just it puts the whole banking system in limbo. So is that the best way for me to do that?
So we're always happy to have a dialogue. So if your office wanted to submit a letter, we'd be more than happy to take a look at it, respond, and if additional discussion would be helpful, we're always open to that.
Okay, thank you. You know, I think as has been said, we just need clear guidelines and expectations of what's going to be required. And it just hasn't happened, at least in the last couple of years. What do you see as the major issues to be resolved? And I guess what's the state of the progress, and how do you think the issues will be solved for the new merger guidelines and the policies that are going to be proposed?
So at the OCC, we have issued a notice of public rulemaking with a policy statement. The comment period on that is open until I believe the middle of June. Once we get all of the comments and we evaluate them, we will then identify the issues and proceed on a path forward. But I don't want to prejudge the process.
At the FDIC, we have our proposed statement of policy on bank merger transactions, similar to the OCC. It has a 60-day comment period. Our hope would be to get the comments in, review those comments, and then eventually finalize.
What is the expected time to review the comments and to either modify or change the regulations?
I don't have a specific date that I'm aware of. Again, it's going to be a function of the comments that we get and taking a look at those and trying to determine what changes, if any, we need to make.
How many people review the comments?
I'm sorry?
How many people review the comments?
It depends on the proposal.
Mr. Dowd, you have any comment on that?
Yeah, that's exactly right. It depends on the rulemaking. It depends on the complexity of the comments. You know, on one end of the spectrum, you have very complex rulemakings that generate quite literally thousands of comments, and then there are rules at the other end of the spectrum that don't generate as much interest. We calibrate our staffing and our response with respect to the number and the complexity of the comments.
Okay. Thank you. Appreciate you appearing. Yield back, Mr.
The gentleman yields, and I'd like to thank our witnesses for their testimony today, and Mr. Dowd, just to finish the thought between you and Mr. Timmons and with me. When Mr. Timmons is talking about the elimination of the expedited review procedures, and when I reference this second factor on the 13 indicators about the resulting institution will have a total assets of less than $50 billion, I understand the OCC's take on that is that it's not a presumptive denial for anything above 50 billion, but that is the inference that's being taken. So that's the feedback that I would give you there, and we'll continue the conversation, and I appreciate the dialogue. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.
May I clarify one part of my testimony?
The hearing is over, but I'll come talk to you. Thanks.